So in January of 2019, financial analyst and investor Keith Gill, who you may know from one of his online usernames, one being a bit less polite than the other, started putting his money towards GameStop. That is, he started investing in the value of that company because he felt it was lower than where it should have been.
I like the stock.
And over the next year and a half, he'd put in about $53,000 towards that belief, with a lot of it seeming fairly unfounded, as the value in the company went down about 2/3 from when he had started. However, by January 27th of 2021, that position that he invested would be worth an estimated $48 million. And what we're going to look at in this section here is how that money came to be, how you get that kind of value from an investment like that through things like stocks, bonds, and mutual funds. Because what we've seen up to this point is a lot of work with what are called cash investments, where you put money in and you get money out. Things like our standard bank accounts from earlier on with simple and compound interest, and things like annuities, where the Fed actually does insure money up to $250,000 in an account. So really, for the vast majority of Americans anyway, it's basically a risk-free investment. But because it's basically a risk-free investment and there's basically no work that goes into managing a bank account,
I'm not in a position where I can help you because the way that my bank account is set up, the thing is, I got a checking in the savings, but all my money is in the savings. I don't think my card is gonna go through unless you got jeans on, because you gotta wipe it off.
there's also not a ton of room for reward. We've seen it in our examples here that yes, if you let something sit in an account for long enough and maybe put a little bit more into it over time, you can get a decent amount built up, but it happens very slowly, and it may not happen at all if you don't put a lot in to begin with.
I just don't understand investments. I told you that.
On the other hand, with things like stocks, and we'll see bonds and mutual funds later, what you're doing instead is investing in the value of a company. A stock is some percentage of the company's value, and it depends on how many are available on the market, how many you buy, how expensive they are to determine the exact percentage you're getting, but you are buying a share of a company. So if you have stocks in a company, you are called, appropriately, a shareholder.
This is not as much fun as I thought it would be.
It was fun when we weren't on the brink of bankruptcy.
We're going bankrupt, you think?
Where this idea of trading in debts and commodities from corporations, people, what have you, is said to have built from ideas in continental Europe, in particular Bruges and Venice, in the 13th century, where the first modern stock, as it were, at least the first thing that we consider a modern stock, is investments that people made in the value of the Dutch East India Company, where this was in 1602 in Dutch, the Netherlands. And today, we can think about these values, these types of things, as basically anything that could be publicly traded. Any publicly traded value, from commodities like oranges.
Crop estimates for next year's orange crop are being delivered from Miami to the Department of Agriculture in Washington, D.C.
Or national currencies.
If you buy $100,000 worth of dinar and it goes to the value of the Kuwait dollar, you're looking at $300 million.
Heaven forbid either of you ever work for something.
To big conglomerated indices like the NASDAQ and S&P 500, all the way to more modern inventions like the cryptocurrency market.
I'm doing the same thing as you. Holding my doink. That's what I'm doing. This is a shit coin I believe in. It's my favorite one, to be honest. Dink Doink is so much more than a meme coin. It's a multimedia coin. Cartoon meets crypto.
Where shares in companies can also be traded through what is called private equity, wherein value is exchanged outside of the public sphere. It's not publicly traded through stocks in this way. And in that setup, usually you're getting bigger money put in and you have bigger risk, therefore you can get bigger rewards, but it's kind of required that if you're jumping in there, you have built-in connections to the company from the start, as well as to other potential investors in the market. This isn't something that a normal person can just jump into and expect to make tons of money on unless they happen to have, known Jeff Bezos when he lived in a garage, supposedly, in Seattle. Anyway, with these types of things, just for reference, this is where you get people like venture capitalists and angel investors as startups get most of their money through these forms of private equity where someone like, say, the sharks on Shark Tank.
Here's my offer, and it's a little bit different. Sell it to me.
Will come in, offer them a large fund for a large share of the company. In return, they'll use their connections to help build the company up, which, thinking about it, if you have a diagram like this describing the relationship between these types of venture capitalists and regular people and other markets, it kind of looks like you're giving them all your stuff, you're giving them your money, they're trading off money, getting back money, but that should be money that's already moving, so why do we have venture capitalists? That's a good question. Anyway, the value of the stock is meant to be something, getting back to the public ideas here, that is tied directly to things like supply and demand.
Brad, show him how it's done. Boom. Sell me that pen. Watch. Go on.
You show us your pen?
That's my boy right there.
This pen.
I'll sell anything.
Would you do me a favor? Why don't you name down that napkin for me?
I don't have a pen.
Exactly. Supply and demand, my friend.
That is, as the value of a company goes up, the value of its stock should go up because the stock represents a percentage of the company. As the percentage of the value there goes up and the price goes up, people will want to buy more so that they have more. And so that will make the value of the company go up and the price will go up, and that's sort of the way this thing works, and it goes kind of in the opposite way as well, or at least it's meant to.
I mean, think about it. Dope goes for way more awesomer price in jail. Supply and command. I mean, if you're in jail, you're lucky to get stoned once a week, and when you do, the dope sucks. So.
There can be some exceptions to this depending on what sorts of markets we're talking about, what sorts of investments are being made, but generally it is meant to follow along with supply and demand, where if you buy a stock, the value goes up, and then you sell it, the money you get there is what is called capital gains. So if you buy some stock when it's worth $1 and then sell that same stock when it's worth $5, you would have 4 in capital gains from that trade. And similarly, if you lose money, so you buy a $5 stock and try to protect yourself, get something back, sell it when it's $1, you would have 4 in capital losses as well. And then, as companies are making money, sometimes they will redistribute the wealth to the shareholders through what are called dividends, but not all end up doing that. Some will reinvest the money into their company so that they can increase the valuation more down the line. Others will do some less ideal things with them, things like stock buybacks, which we saw in this last year went pretty terribly for airlines as they didn't have the money they needed when they were in a very down period in terms of business. But these are all risks that have to be made. These are all choices that have to be made where you're trying to figure out how to maximize your profit, or a company is trying to figure out how to maximize their profit. Where stock trading, the act of buying and selling stocks, used to be a world, at least in terms of how it was seen culturally, dominated by men with slicked back hair and tailored Italian suits.
Greed, for lack of a better word, is good. Greed is right. Greed works.
Working on the New York Stock Exchange, shouting about the values of whatever it is that happened to be making them money that day, whether it's pork bellies or gold or whatever possibly it could have been.
A complete sandwich? You got fleeced. I would have settled for a hard roll with ketchup inside.
But today, thanks to the internet and lots of services that allow regular people to be able to get direct access to the money, more and more day traders, more and more people who are just in it for the moment and can just jump in whenever they want to, have entered, where I will say that you should be careful when thinking about entering the stock market, as especially with those day traders, those retail investors as they're called, the vast majority do end up losing money. And for really all but the most entrenched investors, the ones who are really in the system, who are the system in some sense, the stock market isn't all that dissimilar. It's really only dissimilar in name to a trip to the casino, a trip at the roulette table, a game of blackjack. For example, thinking back to Keith Gill and his GameStop investment, yeah, it was worth $48 million on the 27th, but by the 29th, its value went down to about $33 million. And some of you may hear that and wonder, well, where did that value go? Well, while we might like to think that that went to the diamond-handed retailers over on Reddit's Wall Street Bets page, and to be sure, a lot of it did come from, over the course of that short squeeze, the bigger people like your Melvin Capital and D1 Capital, and it certainly did make some of the financial types angry.
Okay, and this fair share is a bullshit concept. It's just a way of attacking wealthy people, and, I think it's inappropriate. We all got to work together and pull together.
Which I'm not going to complain about. A lot more of it went back to the other big investors. A lot of it stayed with the wealth, with people like JP Morgan and BlackRock, and oddly enough, the Mormon Church. But it's important here to understand that while 53% of Americans had money in the stock market, and yes, you should have money in the stock market, it's maybe not the safest place to put your money, but that's where a lot of pension funds actually end up going, families in the top 10% actually held 70% of its wealth in the year 2019. And there's actually evidence to indicate that that percentage has gotten even more unbalanced since. Because you have to understand here that stock market speculation is pretty much driven by and in the interests of the extremely wealthy, where the main interest that's driving all of this is to get more money.
I'm a millionaire! Suddenly I have an opinion about the capital gains tax.
For example, things like speculated capital gains, the value of a stock as it's interpreted by the market, are a major source of the money that billionaires have. But those don't need to be considered as income or capital gains for taxation unless they are actually sold. And then even in the cases where those things do get sold, capital gains, in particular long-term capital gains, those that are sold after being held for more than a year, which is most of what the very wealthy would be having because they've been there for a very long time, those have their taxes capped at 20% currently, which is considerably lower than the 37% cap that is currently in effect for income. And these types of things, these and other factors, are how people like Warren Buffett.
The real problem, in my view, is, this has been, the prosperity has been unbelievable for the extremely rich people. If you go to 1982, when Ford put out their first 400 list, those people had 93 billion. They now have 2.4 trillion, 25 for one. This has been a prosperity that's been disproportionately rewarding to the people on top.
See their wealth grow. That for Buffett in 2014 to 2015, his wealth went up by $14.5 billion approximately, while also reporting less income than 14,000 Americans, supposedly. Where, just for the record, there were an estimated 536 billionaires in America in 2015, so it wasn't just them who he was getting underneath. And furthermore, because their net worth, even though a lot of it isn't actual liquid cash, is so high, the extremely wealthy, the billionaires, can get loans at rates that would be essentially unheard of for a normal person. Consider Mark Zuckerberg refinancing his mortgage to an adjustable rate of 1.05% in the year 2012. Now it is adjustable, which means that there's a little bit more risk than a fixed-term mortgage, but besides the fact that that is well below the 3% average for 30-year fixed-term mortgages, if it stayed in that neighborhood, if it stayed around 1%, that would put it below the expected inflation value for the US dollar. That is, if it stayed about where it was, the bank might as well have been paying Zuckerberg for the right to take care of buying the house for him.
So, you are trying to block me, huh? That's fine. What's your style? I don't have a style.
Which is pretty ridiculous. And underlines a very important thing that you should understand if you're looking at getting into the stock market, which is when you're investing your life savings, what you're putting your life savings towards, a billionaire might as well be throwing Monopoly like that. It's a very different game. And it's a game where 13 years ago and 100 years ago, we saw that if they lose, we all lose. lose. But in the last year, we saw that even if we're losing, they might not be. So be careful and understand there's a fair amount going here that's well beyond any of our control. Anyway, that's enough talking about the stonks and why they may or may not always go up. Let's also look at these other things, these bonds and mutual funds.